Hello and welcome to the Killik & Co market update for the week ending August the 18th. It's been a volatile week in the markets, with both the S&P 500 and the DAX down around 2% from their highs of last week, and the FTSE 100 down around 3%. Relief earlier this week following an easing of tensions surrounding North Korea has given way to more market volatility following controversy around comments made by President Trump to do with the events in Charlottesville, as well as the terrorist attacks that we've seen in Spain. This has resulted in volatility measures, as measured by the VIX, now close to annual highs. Moving on to economic news, there's been good economic news out of the US this week, with the exception of housing starts and building permits. Most of the US economic indicators have beaten market expectations. Retail sales in the US rose 0.6% this month, beating expectations of a 0.3% rise, while core retail sales, which exclude the volatile components of auto sales and gas, rose around 0.5%, also above forecasts. The National Association of Home Builders Housing Market Index rose to 68 in August, up from 64 in July, while the Empire Manufacturing Index at 25.2 in August was up from 9.8 a month ago, and this is the highest level since September 2014. Away from economic data, the minutes from the Fed's Open Market Committee were largely balanced, although there is a growing concern that the recent weakness in inflation may persist for longer than had previously been anticipated. The meeting stated that many participants saw some likelihood that inflation would remain below 2% for longer than had been previously expected, and several indicated that risks to the inflation outlook could be on the downside. So on future balance sheet reduction, that the committee does remain split, with those wanting to wait, overruling those that are poised to act now. Moving on to the UK, the focus there has also been on inflation data, with various metrics broadly lower and dampening already receding expectations of a Bank of England interest rate rise. The UK Consumer Price Index came in at 2.6% in July. That's unchanged from the previous month, and although it is still above the Monetary Policy Committee, or the MPC's target of 2%, it is below the 2.7% that had been forecast. Looking at producer price inflation, which is a measure of inflation at the factory gate, that came in lower than anticipated, and falling quite substantially from last month. So it fell from 10% down to 6.5%, and the PPI output prices fell from 2.9 to 2.4%. This inflation data saw market-based expectations of a rate rise in the UK before the end of the year, which had been as high as a 58% probability in July, falling to 24.4%. As a result, we did see sterling pull back from some of its recent highs in the currency market. In the ECB, the minutes from the latest Eurozone Central Bank meeting were released on Thursday, and that did bring some weakness in the euro, which fell to its lowest level in a month versus the US dollar. The meeting minutes did reveal that there is some concern regarding the strength of the euro, as well as a feeling that further monetary accommodation is needed to bring inflation to a persistently higher level. Looking at the week ahead, it's fairly quiet as earnings season is almost over. Not much in the way of our covered companies reporting, though we do have BHP and Antofagasta reporting on Tuesday, as well as Medtronic in the US, and then Wednesday WPP. Thanks very much for watching, and that's all for this week.